In this section, we're going to talk about a personal balance sheet. A budget helps you ensure that you have a positive net cash flow. And while a budget tracks our cash flow, we need to work with a balance sheet. We're going to figure out what are we going to do with the cash we have left over. A personal balance sheet helps you make decisions on how to use the extra money. A personal balance sheet, is a statement that describes your financial position at a point in time. Businesses use personal or balance sheets all the time, but you are going to create one with your own personal life. Knowing where you are financially will help you decide how to manage things like your liquidity, how much ready cash you're going to have, your use of credit and borrowing for items, and your investments. And a balance sheet shows a summary of your assets, your liabilities, and your net worth. It will keep track of your overall wealth. Assets on a balance sheet can be classified in several ways. You can have liquid assets, household assets, and investments. Okay, so the first part of our balance sheet is we're going to identify our assets. It's real important to list your assets on a balance sheet because it helps you figure out where you are financially. The first of our assets are liquid assets. Remember, we're going to cover liquid assets, household assets, and investments. Remember, we talked about assets are things of value that we own. Okay, our liquid assets, again, are financial assets that are either cash or can be easily converted into cash without significant loss of value. Liquid assets include money in checking and savings account. And the reason why they're liquid is we can take the money out anytime we want. In our savings account, remember, we also have not only what we put in there, but the interest that we earn. Our liquid assets are necessary for covering unexpected emergency expenses, and we've talked about this a little bit before. It's important that they have quick availability, that we can get this money quick if we need to. It is also important for them to be making money by earning interest. So again, these are our liquid assets, ready to cover emergencies and liquid when we need them. You really want to increase your liquid assets so that you have available money in case there is emergencies. All assets can be converted into cash, but some require that you decrease the selling price to sell quickly. Okay, and so our liquid assets are those. The second category is household assets. Household assets are assets owned by a household, such as your car, your house, furniture, and so forth. Market value is what something would be worth if you sold it today. Okay, just because we have a house that's worth $200,000, if you can't sell it for $200,000 because the market value is lower, you have to report it at what the market value is right now. Again, another type of asset is your household assets. While creating your personal balance sheet, evaluate the true value, market value of these assets. There are assistants out there, the Kelley Blue Book for cars. If you want to figure out how much your car is worth, you can look it up in what's called the Kelley Blue Book. eBay and other internet sites are good resources for determining the value of these assets. So you can go through when you're trying to figure out what your household assets are worth, you can check online. Remember that it's easy to estimate market value and how important it is important for you to understand that what you pay for something isn't necessarily what it's worth. Okay, you have to be accurate and realistic when you are listing your household assets or any type of assets. Investments, then, there's several of those, is something you acquire with the ultimate goal of making more money. Investments, then, is the third major category of assets. Investments are something you buy that you believe will increase in value over time. We're not going to invest in something if we know it's going to fail. Some common investments are stocks, bonds, mutual funds, and real estate. And we'll cover each one of those real briefly to show you what they are. Again, investments are something you put your money into with the hope of making more money. Bonds are certificates that function like IOUs, promising to repay a certain amount of money at some future time. When you buy a bond, you are essentially loaning the issuer money. For example, a company or a government decides to issue a series of bonds valued at $1,000 each. An investor agrees to buy one of those bonds, giving $1,000 to the bond issuer. In return, the bond issuer, agrees to pay interest to the owner of the bond and also repay the $1,000 at some point in the future. So when you buy the bond, you're essentially loaning the issuer money. Excuse me. The issuer will pay you interest until the maturity date, at which they'll pay back $1,000. So you are giving somebody $1,000 and they are borrowing it from you. They are going to pay you back the $1,000 plus interest. And that's basically what a bond is. And again, the issuer pays you interest until the maturity date. So they give you a bond and they will pay you back. People buy bonds expecting to receive interest income while they hold the bond, and they'll get their money back when it matures. Investing in bonds involves some risk. People buy bonds with the expectation of receiving interest income while they hold the bond and getting their money back when it matures. However, the bond issuer is not always able to make payment or even return the original investment. For this reason, investing in bonds is a little bit risky. So when you invest in a bond, you borrow somebody money, they pay you back with interest. Here's a little math problem let's do. Jeff has $1,000 in savings account, $340 in his checking account, and $2,100 in stock that his grandmother gave him. He also owns his car, which is worth about $3,200. How much does Jeff have in liquid assets? Again, this shouldn't have popped up right away, but again, Jeff's liquid assets consist of the money in his savings and checking account, which is $1,000 plus $340 for $1,340. Remember, the $3,200 in stock is not a liquid asset because he would have to sell that stock and somebody would have to be willing to purchase it. Stocks are certificates that represent fractional ownership in a firm. People buy stocks expecting the company will do well and the value will increase. Each share of ownership represents a percentage of the business, and it's called a share of stock. Stocks can be risky, and it's possible that the value will decline and disappear altogether. So again, with stocks, as an individual, you look online, you find some stocks that you want to invest in, you buy shares of stock in a company that you hope will be successful. When that company is successful, they will give you a portion of their profits back to you. If that stock fails, you could lose what you have invested in that stock. So again, there are all kinds of stocks. Some have a little bit more risk than others. A mutual fund is a professionally managed investment that allows investors to pool their money in order to invest in a larger variety of financial assets such as stocks and bonds from many different companies. So with mutual funds, they usually require a minimum investment and they get a bunch of people to invest. Okay, so again, mutual funds are managed by professionals who decide which stocks or bonds to purchase Individual investors who have shares in the fund, you don't have to be experts because, again, they are managed by professionals. The risk of loss is usually spread across many different investors. So even if one or two fund stocks or bond investments collapse, the fund itself may decline only a little bit. This can help protect an investor from a severe drop in the value of an investment. Still, mutual fund investments can and sometimes lose their value. Mutual funds can be used for a variety of purposes. One such use, and a huge one, is a college savings plan. Parents, grandparents, or other relatives can open what's called a 529 plan for their children and make contributions designed to be used for education. The plan helps investors avoid some taxes on their earning and withdrawal from the plan. Mutual funds are commonly used for this type of investment. So again, there's usually a huge group of people that pool their money into mutual funds. They have a professional that decides which funds, which stocks, bonds they are going to purchase. And then the risk of loss and profit is spread among that group of people. Another type of investment is called real estate, and real estate is home, rental property, farms, and other land. People invest in this hoping it will generate revenue over time and increase in value. People buy real estate and sell it hoping the value has increased and they'll make a profit. Sometimes people will buy rental property and then they can rent it out to people, make some money, and when they're all done, they can sell it. And their goal is to make a profit. Emily owns 50 shares of Company Y stock that is currently selling for $170 a share. She also owns 65 shares of Company Z stock worth $47 a share. What is the total value of her stock holding? Okay, the solution, Company Y, she has 50 shares of stock that sells for $170 a share. So that stock is worth $8,500. Company Z, she has 65 shares at $47 per share, and that total would be $3,055. If you add those two up, her total value of her stock holdings is $11,555. So that's basically your assets section of your balance sheet. Your assets, we have to, in order to figure out your balance sheet, we need to know your assets and your liability. Remember, assets are something of value that you own. Okay, and we covered our investments, different types of investments that we can own for assets. We took a look a little bit at stocks, bonds, mutual funds, and real estate were the investments we took a look at. Okay, the second section that we need to figure out for our personal balance sheet is liabilities. And liabilities represent the amount of debt a person owns. These can be put into two categories. We have current liabilities and we have long-term liabilities. Current liabilities are debts that must be paid off within a year. Credit card balances are the most common form of current liabilities. A credit card acts like a short-term loan that should be paid off every month. So you use your credit card and then you should pay it off at the end of the month. When you pay the credit card bill, you are eliminating the current liability. Again, so current liabilities are debts that should be paid off fairly soon. Long-term liabilities are debts that will take longer than 1 year. Examples of long-term liabilities include student loans, car payments, car loans, I should say, and home mortgages. Remember, home mortgages are the amount of money you owe currently on your house. Each payment that you make on your student loans, your car loans, your home mortgage, whatever loan you have, your credit card, each payment includes an interest component, and some amount will be reduced by the initial liability. So when you make your payment, not only are you paying back your loan, but you are paying interest. So again, in the long run, you are going to pay more money than you initially took out because you have to pay interest. Note that some people use credit cards this way as long-term liabilities. This leads to paying more money than originally intended. Again, unfortunately, many people use credit cards in a way that creates a long-term liability. They make purchases with their credit cards that they cannot pay off quickly. As a result, they pay interest on the debt and reduce their liability by only a small portion each month. In general, using credit cards to create long-term liabilities is a bad move. The interest rate charged on most credit cards far exceeds the interest rate individuals could get in a bank or a credit union for long-term financing. It's much better to pursue other kind of financing, such as a bank loan for long-term liabilities. Net worth, again, is the difference between your assets and liability. Figure out your net worth is an easy way to measure your wealth. It's easy to keep track of your wealth over time by using a balance sheet. You can figure out your net worth with a personal balance sheet. Here's a little example of Terrace's personal balance sheet. He just lists his assets, his liabilities, figured out the difference. You can have a negative net worth. It's when you have, obviously, more liabilities than you have assets. Another math problem. Lakeisha's car is worth about $6,000 and she still owes $1,200 on it. She has an outstanding credit card balance of $450. What is her net worth? Okay, let's figure this out. What is her assets? Her asset is her car. She only has one asset. Liabilities is her car loan. She still owes $1,200 on it. She owes $400 on her credit card, so her liability is worth $1,650. To figure out her net worth, we need our assets minus our liabilities, and we come up with a net worth of $4,350. Your personal balance sheet changes as you acquire new assets and liabilities. If you spent all your income on living expenses, your balance sheet would remain the same. However, if you run up your credit card debt and do not pay off the balance at the end of the month, your net worth will decline. If you save some money, then in return, your net worth will increase. So again, your balance sheet changes as you acquire new assets and liabilities. Again, as those change, this will affect your net worth. There are two ways for net worth to increase. The value of your assets increase far more than your value of your liabilities, and you pay down your debt on your liabilities. Analysis of your personal balance sheets. Lenders look at your personal balance sheet to determine if you can pay the loan. If you have more debt or liability than you have assets, you might not get your loan. Loan officers use this debt to asset ratio to determine if you have borrowed too much money or if you can borrow more money. Keep your personal balance sheet in good shape. It can influence the options you have for making financial decisions and having a good financial plan. As a checkpoint, what are the 3 steps in creating a personal balance sheet? First of all, you identify and add up all your assets. You identify and add up all your liabilities. And then you take assets minus liabilities to figure out what your net worth is. A balance sheet can help in measuring financial progress. It reports asset, liability, and net worth on a given date. We are going to prepare a sample balance sheet using the scenario that is on the last page of your notes right here. So we're going to go through the paragraph here step by step and place it in our balance sheet. Okay, so the first thing, you took out a loan 5 years ago for a house with a value of $150,000. You have made payments that total $30,000. Okay, so we have to take a look here. This $30,000 is the amount of payments that you've made. So this is the portion of the house that you own, correct? Okay, your house is worth this, but you own the $30,000. This is how much of the house that you own. So we look through here. Okay, so our assets, our home mortgage, how much do we still owe on that house? Okay, we had $150,000. We've paid off $30,000. So $150,000 minus $30,000, we still owe $120,000 on that home mortgage. In return, we have an asset of a house. How much of the house do we own? We own $30,000 of the house. You look online and you see that you have $1,200 in your checking accounts and $2,000 in your savings. Checking account is what type? Asset or liability? It's an asset. Savings is a asset. So we'll flip to this page, to our balance sheet. Our checking account, we have $1,200 in it. It's an asset. It's actually a liquid asset. Our savings account is also a liquid asset worth $2,000. You just got back from your vacation and you realized you charged $2,300 on your credit card. Your credit card would be a liability. Okay, so we're going to cut our credit card balance, $2,300. Again, if I go too fast while you're going through this on the video, you can just hit pause. Looking around your house, you realize that you have several items that have some monetary value. Your computer's worth $900. You bought new furniture and appliances within the last 5 years worth $8,400. And again, you can check up what they are worth because what you actually paid for them and what it's worth is not always the same. So we're going to go back here. Those two items are assets because there's something of value that we own. Computers worth $900, furniture and appliances worth $8,400. Your grandma gave you some jewelry worth $500. Again, another asset. We'll put in our jewelry of $500. You look at your car and realize it isn't in very good shape, but it's probably still worth $1,300. It's an asset, your car, $1,300. Finally, you remember that you still owe your mom $500 you borrowed from her last month. Again, you owe, so it has to be a liability. You owe mom $500. Okay, we're going to go finish the balance sheet because that's the end of our story. We're going to add up all of these numbers and we come up with $44,300. We're going to add up those numbers for our total liability and we come up with $122,800. Next, we will figure out our net worth. We take our total assets minus our total liabilities and we come up with $78,500, and it's a negative number. When you put negative numbers in your balance sheet, you will put them in parentheses. This isn't such a bad negative number because there is a house mortgage, and the mortgage is going to be pretty high. But you can see you got a pretty solid amount for your assets. So having a negative number isn't always so bad here. What you need to do is pay off this credit card bill. But this will go down every month, probably for the next 25 years. And that is how you prepare your balance sheet.